Imagine an economic theory that could topple the financial world as we know it. A theory so controversial, it strikes fear into the hearts of central bankers everywhere. This is modern monetary theory, or MMT, a fresh perspective on government spending and inflation that's rapidly gaining ground in policy circles. But what exactly is MMT, and why does it have the potential to rewrite the rules of our global economy? Picture this, it's 2008 and the world is on the brink of financial collapse. Banks are failing left and right, and trillions of dollars are evaporating into thin air. In response, the US government pumps massive amounts of money into the economy to prevent a total economic meltdown. But here's the twist. What if that very intervention not only saved the day, but also proved that governments can fund their spending by creating money? That's the core idea behind MMT. It asserts that a government that issues its own currency can never run out of money, as it can simply print more to cover its expenses. This challenges the conventional wisdom that governments must borrow from the public or raise taxes to finance their spending. Now, you might be thinking, isn't that just a recipe for hyperinflation? Not necessarily, say MMT proponents. They argue that a government can increase its money supply without triggering inflation, as long as there is slack in the economy, unemployed resources, and underutilized capacity. So, who's behind this radical theory? Meet Stephanie Kelton, a prominent economist and leading voice of MMT. A former economic advisor to Bernie Sanders, Kelton has been making waves with her book The Deficit Myth, in which she argues that deficits are not only normal, but also necessary for a healthy economy. As we delve deeper into the world of MMT, we'll explore its implications for government spending, taxation, and inflation. We'll also examine the fierce debate it has sparked among economists, policymakers, and central bankers. And, perhaps most importantly, we'll ask, could MMT be the key to solving our economic woes, or a ticking time bomb waiting to explode? As we continue to unravel the mysteries of modern monetary theory, or MMT, it's crucial to understand its fundamental principles. At its core, MMT is built on the idea that governments create and control money. This may sound like common sense, but it challenges long-held beliefs about how economies should function. To illustrate, let's look at the United States. The US government spends by crediting private bank accounts, an action known as monetizing government spending. Essentially, when the federal government runs a deficit, it injects fresh money into the economy. This is not a new phenomenon. The U.S. has been doing this since its inception, with one notable exception, the Federal Reserve's establishment in 1913, which introduced an intermediary between Congress and the money supply. MMT proponents argue that this intermediary, the central bank, unnecessarily complicates the process of monetary management. They believe that governments should take a more active role in controlling their currencies to ensure economic stability. This approach would entail managing the economy based on real resource availability, rather than arbitrary financial metrics like inflation targets or gold reserves. Critics argue that giving governments such power over money creation would lead to hyperinflation and economic ruin. However, MMT economists counter this by pointing out historical examples where large-scale government spending did not result in rampant inflation, such as during World War II. They also emphasize the importance of taxation under MMT. While taxes don't fund government spending per se, they do help control inflation by removing excess money from circulation. Moreover, MMT acknowledges that while a government can create money without limit, it doesn't mean it should. The theory stresses that responsible fiscal management is still essential to prevent excessive demand for resources from outstripping supply, which could indeed trigger inflation.